Can two neighbors who share a border, a currency peg, and a trade bloc really be betting against each other on the future of the world's second largest economy? Temasek just made its biggest China deployment in 5 years, while Khazanah's money is quietly heading west. This is Malaysia and Singapore, two neighbors, two opposite bets on China. Across Southeast Asia, sovereign wealth is breaking away from traditional consensus. What looks like a simple portfolio tweak is actually a fundamental split in how regional capitals prepare for a fragmented global order. Act 1. $10 billion one way, 8% the other. Look closely at these numbers, because they tell two completely different financial stories. $10 billion flowing in one direction, while just 8% remains in the other. Two close neighbors sharing a single geographic border and operating within the exact same regional trade bloc are making opposing strategic moves. While one state-backed investor doubles down on Chinese assets, the other is quietly reallocating capital into Western markets. For decades, the economies of Southeast Asia operated on a comfortable and highly profitable blueprint. They relied on the United States for security and consumer export markets, while plugging directly into China as the primary engine for domestic industrial growth. It was a masterclass in double-sided hedging. But as you trace the shipping lanes across the region, those long-standing financial foundations of total neutrality are beginning to fracture under geopolitical pressure. In July 2026, Singapore state investment firm Temasek Holdings raised its China exposure by 10 billion Singapore dollars, or roughly 7.7 billion US dollars. This marked its largest single-year capital increase in China in half a decade. What makes this move striking is the timing. Temasek executed this deployment precisely when major Western institutional investors were sprinting for the exits, effectively taking a bold contrarian stance against global market momentum. Just a few kilometers across the causeway, Malaysia's sovereign wealth fund, Khazanah Nasional, presents a completely different strategic picture. While Khazanah executives publicly praise the long-term innovation curve of Chinese firms, their latest institutional review shows China comprises just 8% of their total portfolio. Instead of expanding its footprint in Beijing, Khazanah has kept its capital heavily concentrated at home, while routing new international allocations into developed Western markets. These figures are far more than balance sheet allocations managed in corporate boardrooms. They directly touch the everyday lives of citizens in both nations. In Singapore, Temasek's investment returns represent the single largest source of revenue for the annual state budget, effectively shielding residents from harsher domestic tax burdens. In Malaysia, Khazanah delivered 2 billion ringgit, or roughly 430 million US dollars, in direct dividends to the federal treasury in financial year 2025 to support public spending. The era of consequence-free hedging is over. Act 2. The fund built to gamble. The fund built to guard. To understand why these two sovereign funds have taken such radically different paths, we need to look beneath the surface at the distinct historical architecture of state power in both capitals. One fund was designed from its inception to take concentrated risk, while the other was structured primarily to preserve domestic stability. Founded in 1974, Temasek was built to operate with a high-conviction, equity-heavy mandate. That structure means taking concentrated large positions in targeted growth companies rather than spreading capital thinly across broad market indexes. Temasek aggressively rode China's early banking and consumer internet booms, establishing a corporate culture comfortable with short-term market volatility in exchange for massive long-term outperformance. Khazanah operates under an entirely different dual mandate. It is tasked with growing national wealth while simultaneously driving domestic strategic development across Malaysia. As a result, roughly 60% of Khazanah's total portfolio remains structurally tied to domestic public equities, national infrastructure, and government-linked corporations. This heavy home market anchor leaves the fund with significantly less flexibility to pursue high-stakes international bets. Over the past 5 years, the global rules of sovereign investing changed completely. The easy era of buying broad consumer internet platforms like Tencent for passive index returns has vanished. 5 years of tightening United States export controls and investment restrictions have forced institutional capital into a corner. Investors can no longer remain neutral. They must actively choose whether to back high-tech sectors like artificial intelligence and semiconductors inside China, or exit those markets entirely. Act 3. The corridor that wasn't on any map. This divergence points to a fundamental strategic disagreement between Singapore and Kuala Lumpur. It comes down to two opposing calculations about which global market offers genuine long-term value and which side of the geopolitical rift carries the greatest structural risk for state assets. Singapore's thesis centers on value. Temasek views Chinese tech valuations as heavily depressed, creating a generational buying opportunity that risk-averse Western capital is simply too cautious to pursue. At the July 2026 performance review, Chief Executive Officer Dilhan Pillai directly defended a lower 5-year total shareholder return of 4.6%. He argued that year-to-year performance is a flawed metric for a sovereign investor, pointing instead to 10 and 20-year horizons. Yet Temasek's strategy is about extreme selection, not uncritical buying. China now represents 17% of the fund's underlying portfolio exposure, down from 24% a decade ago, making it Temasek's third largest market behind Singapore and the Americas. Rather than buying the broader market, Temasek is strictly targeting hard tech champions, Chinese firms actively building domestic alternatives to Western-supplied components. Across the causeway, Khazanah has taken the opposite path under its Advancing Malaysia framework. Managing Director Datuk Amirul Faisal Wan Zahir has directed international allocations toward the United States, Europe, and Japan, which now account for 15.5% of the portfolio. By anchoring capital in stable, highly regulated Western markets, Khazanah seeks predictable dividend yields to insulate its portfolio and fund domestic economic development initiatives under the National Economy Medani agenda. These choices highlight two fundamentally different structural anchors. Singapore relies on absolute global capital outperformance to maintain its financial strength and defend its currency valuation. Malaysia relies on Khazanah as a fiscal buffer, using sovereign capital to absorb external economic shocks and protect industrial employment in regional manufacturing hubs like Penang. Act 4. The consequence chain. These structural choices made inside boardroom meetings do not remain isolated on trading floors. They set off direct financial consequence chains that cascade all the way down to everyday households in both countries. If Temasek's high-conviction bet on Chinese innovation pays off, Singapore will solidify its position as the premier global hub for non-aligned capital. Chinese hard tech companies seeking capital will flood the city-state with secondary listings, expanding the net investment returns contribution to the state budget. For a local family living in public housing in Ang Mo Kio, that sovereign windfall means direct government cost of living offsets and enhanced utility rebates funded by global investment returns. If Western sanctions successfully freeze China's technological advancement, the downside chain takes effect. Valuations will face permanent suppression, forcing Temasek into severe portfolio write-downs. As sovereign investment returns contract, the Singaporean government would face immediate fiscal pressure to raise domestic consumption taxes or trim public infrastructure spending, directly reducing household disposable income. Conversely, if Chinese tech valuations remain suppressed under persistent Western containment, Khazanah's cautious Western tilt will look remarkably prescient. Steady investment yields from the United States, Europe, and Japan will continue flowing into Kuala Lumpur, keeping federal dividend payouts intact. For a manufacturing worker in Penang's industrial corridor, that stability ensures ongoing investment in local infrastructure without the shock of a sudden sovereign portfolio collapse. However, Khazanah's heavy exposure to Western equities carries its own distinct vulnerability. A sudden tariff shock or inflationary spike across Western economies could spark a sharp market correction, causing Khazanah's baseline portfolio returns to drop rapidly. If annual dividends to the Federal Treasury fall below the 2 billion ringgit mark, public spending tightens, directly freezing local school upgrades and infrastructure projects in states like Perak. Act 5. The deeper implication. This growing divergence between two of Southeast Asia's most sophisticated state investors points to an undeniable reality. The historic ASEAN playbook of passive neutral hedging is officially broken. For decades, regional governments enjoyed the luxury of nodding politely toward Beijing while banking steady financial returns in New York. They operated under the assumption that both economic spheres would stay commercially intertwined. That era has ended. As technology markets bifurcate, state-backed funds can no longer maintain passive index holdings across both systems. They are being forced to decide which superpower's economic foundation will prove durable. What we are witnessing across the Johor Strait is a quiet financial uncoupling within Southeast Asia. Even while formal diplomatic rhetoric remains carefully balanced, sovereign billions are pulling in opposite geographic directions. As the global technology order splits in two, regional leaders face an unprecedented strategic question. Is it riskier to bet billions on a contained giant fighting to build its own tech ecosystem, or to trust your future to a dominant West that is quietly rebuilding its own walls? That leaves every government in the region standing at the same crossroads, and the map of choices looks something like this. On one axis, how much trust do you place in the Chinese ecosystem versus the Western order? On the other, how much strategic autonomy does that choice actually buy you? Stay agile, and you diversify supply chains and partners without picking a side, which sounds safer until you remember that neutrality has a shelf life. Hedge your bets across both systems and you get balance at the cost of never fully capturing the upside of either one. Temasek and Khazanah have already answered this question, just in opposite directions. So here is the one you are left with. Is it riskier to bet billions on a contained giant fighting to build its own tech ecosystem, or to trust your future to a dominant West that is quietly rebuilding its own walls? I am Hero the Hornbill, and this is the ASEAN Angle. If this episode gave you a new way of seeing the region, subscribe so you do not miss the next one. New episodes weekly, link in the description.